Hello guys, myself Mrs.G.Kirthika, Assistant Professor of Commerce, Sri Sharda College for Women, Autonomous, Salem 16. My topic is about risk management. Introduction. A business firm carries its operation in an environment which is not within its control. It is exposed to all sorts of danger, both internal as well as external factors. It may not be in a position to withstand its competitors. Its product may deteriorate or become obsolete and thus suffer a fall in their market value. Its properties may be stolen or destroyed. The employees of the company may embezzle the money, etc. A finance manager has to keep all these dangers in view. He has to maintain the probability and liquidity of the firm, keeping in view the overall objectives of the firm. He has to keep himself prepared not only to meet the planned funds requirement of the firm under deal circumstance, but also those which may occasionally arise due to unforeseen contingencies. Risk. Risk may be defined as the chance of future loss that can be foreseen. In other words, in case of risk, an estimate can be made about the degree of happening of the loss. This is actually done by assessing probability to the risk on the basis of past data and the probable trends. Types of risk. The risk can be of various types as shown below: pure and speculative risk, static and dynamic risk, fundamental and particular risk, financial and non-financial risk. First, pure and speculative risk. Pure risk are those that can only result in loss, whereas speculative risk can either yield a profit or a loss. For example, an earthquake or a flood could cause only loss, whereas if a person invests money in, for example, in stock or real estate, he may either gain or lose for some time. Such risks are called speculative risk. Second one is static and dynamic risk. Risk at a point of time, such as earthquake, fire, etc., are static risk. The risks that are continuously changing, such as change of taste or fashion, or are dynamic risk. Static risk result in losses that are more predictable and hence can be better handled by insurance company, while dynamic risks are irregular and more unpredictable. Third one is fundamental and particular risk. Fundamental risk are those affecting group of people or a society at large, while particular risk affects an individual. Thus, for example, burglary of family jewelry or office computer is a particular risk, while floods are fundamental risk. Next, fourth point is financial and non-financial risk. Risk that affects the finance of the organization. For example, losses of income or assets are financial risk, while risk that affects other issues such as brand name, goodwill, reputation are non-financial. Financial risk may also be due to fluctuating in interest rate or currency values or default by customers. Next, we are going to see about components of risk in business finance. In business finance, risk refers to the uncertainty and potential for adverse outcome that can affect financial performance and the achievements of business goals. Risk can arise from various sources, and it's important to understand the components of risk that business faces. Here are some key components of risk in business finance. First one is market risk. Market risk, also known as systematic risk, arise from external factors that impact financial markets. This includes fluctuation in interest rates, exchange rate, and overall economic conditions. Businesses may be exposed to market risk when they have investments or operations affected by these external variables. Second one is credit risk. Credit risk, also called default risk, it relates to the possibility of counterparties failing to meet their financial obligations. This can occur only when businesses extend credit to customers, invest in bonds, or engage in leading activities. Credit risk assessment is crucial for managing exposure to potential defaults. Third one is operational risk. Operational risk systems from internal processes, systems, peoples, and external events that can disrupt a business operation. This includes factors like human errors, technology failures, supply chain disruptions, and legal and regulatory issues. Effective operational risk management is essential to minimize these disruptions. Fourth one is liquidity risk. Liquidity risk is the risk of not being able to meet short term financial obligations due to a lack of available cash or easily convertible asset. It can occur when businesses have mismatched cash flow or illiquid investments. Adequate cash management is key to mitigating liquidity risk. Next, fifth point is creditworthiness risk. This risk this risk is specific to credit dependent businesses. It involves the assessment of customers and counterparties' creditworthiness. Businesses may face losses if customers default on payments or if they have no properly evaluated the creditworthiness of suppliers or partners. Next point is reputation risk. Reputation risk pertains to the potential damage to a company's reputation due to actions, events, or public perceptions. Negative publicity, ethical lapses, product recalls, or social media controversies can harm a company's image and impact its financial performance. Next, seventh point is regulatory and compliance risk. Businesses are subjected to various regulations and compliance requirements. Failing to comply with these regulations can result in legal actions, fines, and reputational damage. Regulatory changes or uncertainty can also create compliance risk. Strategic risk. Strategic risk is associated with the decisions and strategies adopted by a business. Poor strategic choices, market shifts, or disruptive technology can lead to financial losses. Effective strategic planning and risk assessment are crucial for managing these types of risk. Next one is environmental and social risk. In an increasingly sustainability forced world, businesses face environmental and social risk relating to environmental impacts, social responsibility, and stakeholder expectations. Failure to address these concerns can have financial consequences. Next, last one is currency risk. Currency risk arise from exposure to fluctuations in foreign exchange rates. This is relevant for businesses engaged in international trade, investments in foreign markets, or having foreign currency demonstrated assets or liabilities. Understanding these components of risk is essential for businesses to develop comprehensive risk management strategies. Effective risk management involves identifying, assessing, and mitigating these risks to protect financial stability and supporting long term successes. The common steps in risk management includes risk identification, risk analysis, risk mitigation, risk monitoring, and risk communication. Risk management typically follows the following steps. First one is risk identification. This step involves identifying potential risks or threats that could affect a project, organization, or specific situation. It's essential to create a comprehensive list of risks. Second one is risk analysis. After identifying risk, you need to assess their potential impacts and livelihood. This helps to prioritize which risk requires more attention. Third one is risk assessment. Determining the level of risk for each identified risk by combining the potential impacts and livelihood. This helps in categorizing risk as high, medium, and low. Next one is risk mitigation. Once risks are assessed, develop the strategies to mitigate or reduce their impact. This may involve avoiding, transferring, accepting, or mitigating the risk. Fourth point is risk monitoring. Continuously monitoring the risk throughout the project or situation. Regularly assess Regularly assess whether new risks have emerged or if the existing ones have changed in nature. Next one is risk communication. Effective communication is crucial to ensure that stakeholders are aware of the identified risk and the measures in place to manage them. Next one is risk reporting. Regularly reporting on the status of risk and the effectiveness of risk mitigation strategies to stakeholders such as project teams, management, or investors. Next point is risk review. Periodically reviewing the entire risk management process to assess its effectiveness and make improvements as needed. These steps may vary in complexity and detail depending on a specific industry's project or organizations. Risk management is a process of identifying, assessing, and prioritizing risk and then taking steps to mitigate or manage those risks. It involves understanding the potential threats to an organization or project and implementing the strategies to minimize their impact. Thus, to minimize these risks, the organization should implement strategies that reduces the livelihood and impact of these potential threats. Here are some common strategies to minimize the risk. First one is risk avoidance. Avoid the activity or situation that presents the risk. This is the most effective way to eliminate risk but may not always be feasible. Second one is risk reduction. Take actions to reduce the probability or severity of a risk. For example, investing in better security systems to reduce the risk of theft. Third one is risk transfer. Shift the risk to another party, often through insurance or outsourcing. This does not eliminate the risk but can mitigate its financial impacts. Next one is risk acceptance. In some cases, it may be reasonable to accept certain risks, especially if the cost of mitigation outweighs the potential loss. Next one is diversification. In finance, spreading investments across various assets can reduce the impact of a poor performing asset on our overall portfolio. Next one is contingency planning. Develop the contingency plans to respond effectively if a risk materialize. This may include having breakup systems or alternate suppliers. Next one is continuous monitoring, regularly assessing and updating your risk management strategies. Risk can change over time, so ongoing vigilance is essential. Next one is safety measure. Implement safety measures, training, and protocols to protect against risk in various environments such as workplace safety procedures. Next one is due diligence. When making decisions, conduct through research and analysis to understand the potential risks and benefits involved. Next one is legal and regulatory compliance. Ensure your activities comply with relevant laws and regulations to minimize legal and compliance risk. Next one is financial risk management. Use financial instruments such as hedging to mitigate risk related to currency exchange rates, interest rates, and commodity prices. The specific strategies choosing will depend on the nature of the risk, the content, and your resources. Risk management is a dynamic process that should be integrated into your overall decision making and planning processes. Advantages of risk management. First one is increased opportunity for identifying and avoiding risk. The first and foremost important advantage is that clear risk management processes makes it easier to mitigate and avoid risk. Second one is more accurate project projection. When risk potential is identified earlier, it has a favorable influence on the budgeting process. It can help calculate a budget accurately. Third point is fewer emergency. Catching potential risk earlier leads to fewer emergencies situations and a more stable and predictable workforce. Next point is better communication. Establishing a practice of proactive communication can make the organization more productive activities. This means that the stakeholders are aware of new information as it becomes available, whether it is good or bad. Next point is ability to grow and evolve. Risk management processes improves as you gather and reach to risk over time. The more experience your teams have with assessing and controlling risk, the more effective they will be. Next one is it provides guidelines. It provides prior guidelines about the framework that is enabled within the experience and assessing the risk that are modeled within the strategies of risk. It has the development of advanced risk management techniques that are interrelated within the consequences of the gained knowledge and the other risk. Managing strategic plans. Managing risk has the strategic plans that are related to the plans that are most used in various strategic plans. This manages the data that depends on most of the resources that are linked to the mitigation defining data. It reflects on the generated data that manage most of the generated cash flow that are in adverse situations. Next one is disadvantage of risk management. First one is complex calculation. Risk management involves complex calculations in terms of managing risk. Without the automatic tools, each and every calculation regarding risk becomes difficult. Second point is depends on external entities. Managing risk depends on the external entities that are modulate within the organization, usually depends on the external data. It includes all the dependent informations about the risk regarding other valid resources. Next point is difficulty in implementing. Risk management takes a long time to gather information regarding strategic plans. It has universal standards that are mitigated and accepted according to the monetary values. Therefore, these are the advantages and disadvantages of risk management. Thank you.